Hello everyone, and welcome to our discussion today on trend and momentum trading. I'm going to talk to you about the Rime's Range Bar Sniper, your trading assistant, as well as show you a trading system today that's very, very simple and something you can immediately start testing, all for free. So let me get my slide working here. Okay, so welcome everyone. I appreciate you being here. I'd like to thank AgenaTrader. Your commitment to trader education is greatly appreciated. What we're going to do is talk about showing you the next level of trading education where the power of trend and momentum, this type of trading, is placed directly on the chart. We're going to talk about a specific entry, specific protective stop, trailing stop suggestion, everything for you, immediate ideas for testing. Now, we're going to talk briefly about how we use the Rime's Range Bar Sniper add-on. You're going to see some charts with signals provided. However, I'm going to show you the underlying methodology to where you can actually do this yourself. So seeing is believing, and pictures are proof, and I want to show you everything. I'm going to demonstrate a trailing stop and semi-automated trading environment as well. Here's our disclaimer. Just a reminder, we are all adults here. Trading financial instruments using contracts, stocks, or options is extremely risky. Only trade with money you can afford to lose. Past results do not guarantee future results, and please consult a licensed professional prior to trading real money. Importantly, you should paper trade to learn any new concepts. Paper trade regardless of your level of expertise. The market will always be waiting for you. Now, a little bit about me. I've been doing this trading thing for 25 years. In 2008, I launched a newsletter called Hit the Mark Trading. And basically, I was fed up with the difficulty out there to learn how to trade. New people learn how to trade. So I decided to launch a mentoring service. In 2013, I put this in a video format. I also provide total immersion intensive boot camps. And this is for position trading about 4 times a year, as well as just day trade, which is my most popular course, and it's 6 hours of total day trading immersion. All right. Everything that I talked to you about today is applicable for stocks, option, bond, futures, forex, or for the European traders. I think you like to use the CFDs, and you can certainly use this methodology on CFD trading. I've got all types of indicators experience. I have experience with automated trading systems. I've spoken at trading conferences and provided numerous webinars for traders where I'm constantly promoting what I hope is a relaxed and simplified approach to your trading. So this is me. This is my trading room. I'm speaking to you from the trading room right now. So outside my window are orchids. I'm in sunny Southwest Florida. So again, the Hit the Mark Trading, you can go to my website to get more information about that, hitthemarktrading.com. And remember that in day trading, which we're going to talk about today, this is the most demanding. What that means is you must copy the professionals. Keep your trading simple so that you can react. You know, the trading professionals are using very simplified methods. It is the retail trader that complicates. So in everything we do, whether we are day trading or we are position trading, we're looking at charts with an all-encompassing point of view. price action, trend and momentum, a price oscillator we will talk about, and I also look at market linkages. So for example, I would never ever trade gold without knowing exactly what is the US dollar doing. I post Rooster Call both on the Trader's Yard site, and then I send it out if you're on my newsletter mailing list. I'll send this out to you for 30 days free, and then thereafter I'll send it to you once a week. So if you're interested in this, I think you should consider it. The Rooster Call is my morning note. It takes me about 2 hours to write it. It takes you about 3 minutes to read it. It's a trader's perspective of what's going on in the news overnight, that day, with some macro considerations, and then I'll tell what's going on, where we expect ES to go, things like that. So it's very informative. Now, I just held a course on the day trading last May, and I've got these recordings available. So if anyone is interested, again, go to the website, hit themarktrading.com, and you'll get 6 hours of very intensive methodology. Okay, let's go to our feature presentation. We're going to talk about the Rime's Range Bar Sniper package, an add-on feature for AgenaTrader. Basically, we are putting the power of a semi-automated trading strategy in your hands. So all the charts are created with AgenaTrader. I use range bars, but the methodology that I am presenting that you can start testing, it's robust for use on any time frame chart. If you use tick charts, volume, Renko, time, anything, that's the definition of being robust. All we asked for is momentum and a trading range. So I asked the question, what if you had a trading assistant? I mean, you're at your desk by yourself, most of you, and you are always challenged to focus. I know that because I'm challenged. What if you had a trading assistant that monitors several markets and calls out the setups? How easy is that, right? What if all you had to do was scan the suggested setup, which is put on a chart in front of you, and you either agree or disagree? Would your trading be more relaxed? In other words, could you let the market come to you? That's the question. Now, this is a chart of CL today, okay? And I'm showing some of this for European and Asian trading hours because the markets never sleep. And notice where I have the arrows. These are your sell signals. Okay? We had, let me get my pointer here. We had one little sell signal here. Hello, I see that. That's my clock over there. We had one little sell signal, buy signal here. I see that. Wouldn't it be great? Wouldn't it be wonderful if everything was 100% and you had no losses? Guess what? That does not exist. Okay? Trading is all about statistics. The more trades you take, the more your strategy, your edge, has a chance to work. It's no different than when if you play cards or you go to a casino. Your trading strategy is not going to come out to be measured except over time. Okay, so what we find here is that this was a beautiful day, wonderful signals, and boom, down we go. Hello. Boom, down we go. Hello. Boom, down we go. Hello. I'm going to teach you about the CCI today. I'm going to teach you about this today. Down at the bottom, this just tells you, okay, I got one signal that says go long. Look at all these short signals. Now, a little bit about this guy right here. Let me get my pen. Okay. When you see something like this, if you can see at the bottom, I got these 3 points at Rime Short Master. What that's telling you is that we have a lot of downward pressure building, and you need to be aware of it. This is a cluster. You need to be aware of this. And so boom, down we go. Now most Americans are asleep. European traders, right? Asian traders could have caught this. All right, here's another one. Boom, go short. Boom, go short. The rest, as they say, is history. Okay. Okay, one thing about this Rime's Range Bar package, the add-on for AgenaTrader, is we are monitoring multiple markets. What does that mean? Well, we can monitor all equity index futures. We can monitor, or if you're looking at a different variety of CFDs, or if you're looking at a different variety of Forex pairs, or if you are looking at commodities and futures. Even if you say, you know what, I want to watch Apple stock while I trade the NQ. That's not a bad strategy. Maybe you want to watch Amazon at the same time as you're watching Apple and trading NQ. That makes total sense to me. The point is, you've got the ability to monitor multiple markets, even multiple chart time frames. I know a lot of Forex people love multiple chart time frames. No problem. The software is going to scan the signal. I have built in 16 criteria we check. 16 criteria. The orders are preloaded when the conditions are met, and you're given an audible sound and a visual. Hey, take a look. Here's a signal. Here's a potential trade for you. Not only that, but you've got the entry, you've got the exit, and the trailing stop. All of this is done for you. This is what we mean by semi-automated. You are the trader in command. You decide whether you're going to take this or not. Okay? Now, we can become even more automated. Let's suppose you have your account size and you've got a method that you have plugged in there for money management. So as you as you have more wins, you have more profit, you can automatically size orders, add positions as you are making more money. What if you are losing money? Automatically, your assistant can take positions off. In other words, you are simply focused on one aspect of the trading, and that is size up the trade, decide to take the trade or not. Everything else can be done completely for you as you have defined. You are simply left to trade the markets. You truly are the trader in command. Now, it's called semi-automated because this does not fire by itself. You can do that if you'd like, but most people prefer to have the final decision at the time, and that's why we call it semi-automated. Now, you've got with AgenaTrader, what you've created, what I've talked about earlier, is what? It's a money management back office. It's as if you have somebody saying, okay, we're up $1,500. We feel comfortable. Let's add a position. Or, look, we're down $1,000. Let's reduce our exposure. Maybe the market's not flowing. Maybe there's no follow through. Maybe there's too much chop. Maybe it's just wild. So let's just start taking off more aggressively than what we're adding contracts. Okay? What's the main point? You predefine this, you are the trader in command. So your job is to now just find moving markets. For a lot of people, that's a huge relief. You decide if you like the suggested trade signal, and you either enter or you decline. End of story. AgenaTrader takes care of the rest. So let's get into the methodology now. We're going to talk about, well, what is momentum trading? Momentum trading is the art of spotting a market ready to move, selecting a trade, entering the trade with confidence, and utilizing predetermined exit points. Momentum trading builds off a firm understanding of support and resistance along with known areas price is attracted toward moving. Now that's important. Momentum trading is trading directionally up or down, riding the price wave rather than reacting to what might happen or what we think could happen. This is usually accompanied by a price oscillator. Don't worry, I'm going to show you one. And we use this for intraday and short-term trading. Short-term trading, position trading, can be defined as holding over a few days or weeks. Today's about day trading. So when you're day trading, you will use the daily chart as your big picture. You will use a short-term chart for tactical entries. As a very general rule, the more volatile the market, the smaller the time frame. Got that? Now markets move in three directions: up, down, and sideways. If a market is sideways, we are greatly challenged unless the range is large. Therefore, it is absolutely imperative to finding moving markets. I believe this is your number one job. I believe, and I've been doing this for a while, I believe that entries are a dime a dozen. I really do. Your job is finding moving markets and then refining your exit points. So what this means, for example, I've got clients that they come to me and all they want to trade is the ES. Okay, that's all they want to trade. No problem. Except when markets don't move. So in 2017, practically the entire year, we had some very tight markets in equity index futures. Okay, you have the odd day there was a big move. Beyond that, it was very tight. As we look into August coming up, the first 2 weeks are notorious for very, very slow, dead markets for equity index futures. Absolutely. Europe is on vacation. Americans are wrapping up vacations. So there's just nobody. So what do? In the first 2 weeks of August, we look at gold. It seems to move. We look at crude. It seems to move. Okay. The bottom line, it is imperative you find moving markets. Now, when we talk about an oscillator, we understand that oscillators derive their power from price movement. So for this reason, you really need to understand how to read the price action, especially at support and resistance areas. The oscillator then provides you a trigger point for entry. Okay? Now, this is what most traders look like when they're trying to either figure out which oscillator to use, or they just want to act like, hey, I know this is it. This is the best thing to use. Okay? I don't know if you're familiar with the story of 6 blind men. 6 blind men in India, right? This is a very, very old fable. And the first guy, they're all touching an elephant, different part of an elephant. And they're describing the entire elephant based on what little thing they're touching. So for example, this guy in the front's got the trunk. This guy in the back's got the tail, right? So the guy in the back thinks it's a snake. The guy in the front, he has no idea. As he moves his hands up, it gets bigger and bigger. The guy holding the tusk says, well, this is something dead. Well, if we look at how traders decide what oscillator to use, the first thing they're going to do, they get attached to these things. MACD, okay, it's the best, it's the best. Another guy says, no, RSI, RSI, you can't beat it. Another one says, no, I like percent R. It's just everything. Another guy says, well, I got to have Bollinger Bands. I got to envelop the market. Bollinger Bands is what I need. Or this one who says, no, I want an expensive proprietary because the more money I spend on something, it must work, right? That's the way the logic goes there. And then the guy back here, well, no, slow stochastics. And then you got some people saying, well, hell, I want to use all of them. I want to use every single one. Tons of oscillators exist, and I mean hundreds. You can't use all of them. In the beginning years, as a position trader, I used slow stochastics, MACD, Williams percent R, and RSI, and I probably had the Bollinger Bands on there. When you position trade, you don't look at what happens during the day. I didn't. You base everything on end of day, which means markets are closed, you have your favorite beverage, you are relaxed, you're doing analysis, and you can throw as many oscillators as you want on a chart. That's great. It makes you feel good when they all agree. But when I got into the day trading, it became apparent. If I'm using 4 different indicators, or 5, and I'm waiting for all of those to add up and give me a signal, I'm late to the party. I'm absolutely late. So I use only one indicator, and that's the Commodity Channel Index. It's also called the CCI. Now let's have an understanding, and I'm the only guy who will probably tell you this. In a strong momentum market, all price oscillators work, and I mean everything. In a tight range market, all price oscillators will lose their predictive value. Therefore, what I'm telling you is there are expensive proprietary oscillators out there. And the people that sell those are never going to show you what happens in a tight range market because they just lose their predictive value. When we know this, when we accept this, then we understand more to the point that we must monitor several markets looking for momentum. Now the CCI, what is it? The Commodity Channel Index is a price oscillator created by a gentleman named Donald Lambert. I met Mr. Lambert, talked to him. In a moving market, the CCI is shown to lead price. Now do not take my word for it, right? But check out John Murphy's opinion in his book, Technical Analysis of the Financial Markets. Now this is a required reading for people that want to obtain their chartered market technician's designation. And what he's saying is, as the CCI goes down, price is going down, right? So we go down here. This, by the way, is called triple divergence. We go down here, and guess what? Price goes down. We're coming up here. Price goes up. We go down. Price goes down. Here, CCI goes up. Price goes up. Now, if this is a momentum indicator, what we understand completely is whatever gets you in early has a propensity to get you out early, right? We know that. This is why in my trading and in my method that I use, I am looking at filters to improve on the CCI, and that's incorporated in the Rime's range bar sniper. Okay. So the CCI is a price oscillator. All you need to know is that we're comparing price with a simple moving average over a selected time span. Mr. Lambert suggested a 20-day period. For day trading, we are going to do one little change. We adjust the CCI to 14 from the default chart setting. So when you get your chart package and you have CCI, they're all set at 20. You go in there and you change it for day trading to 14. And we are looking at smaller time frames in moving markets that are showing a good range. I also believe in trading the rush hour rather than all day. So the chart here, all I want to show you, and I want you to focus your eyes on, just focus your eyes on the histogram. We have a zero line. This is major support and resistance. We have the 100 line in red and minus 100 line. This is a form of minor support and resistance. We have 150 and minus 150. Another form of minor support and resistance. Therefore, if you break through the 100 line, you're breaking through resistance. If you break through the 150 line, you're breaking through resistance. Okay? All right. If you are below the zero line, what does that mean? We have a downward bias. If you are above the zero line, what does that mean? We have an upward bias. How simple can that be? You know, I think it's great to be a visual trader, by the way. I really do. Day trading is perfect for visual trading. So many people come to me and say, you know, I've got ADD and I'm very distracted. Well, visual trading is right up the alley for the person who says they are easily distracted. Now, how do you calculate the CCI? Don't worry about it. The software platforms have this automatically done for you. You simply define the period. When I say define the period, that means you use either 20 or 14. Now, I'm going to show you the calculation, and you can watch this on your own time and freeze this and memorize this if you want to. It's not an issue for me. The people that want to memorize this are doctors, engineering types, airline pilots, people who are used to absolute precision. No problem. I believe what you need to know is that the CCI is plotted on a histogram. The zero line is major support and resistance. The 150 and 100 lines, plus and minus, represent minor support and resistance. So there's the chart again. Okay? So look here. I'm above 100. I should have an upward bias on price. I'm below the zero line. I should have a lower bias. Did I say above the zero line? I meant to say I'm above the zero line. I should have an upward bias. I'm below the zero line. I should have a lower bias. I'm above the 100 line. I should have an upward bias. How simple can this get? That's the question. All right, let me get my mouse working over here. Okay. We're going to talk about the diagonal trendline break. Very powerful, very auspicious the way it works. And my rule is you start drawing it from the 150 or minus 150 line. Simple concepts, and the diagonal trendline break, I'm telling you, it's a wonderful tool. So I'm going to go to the live charts now. Okay. Just a moment, here we are. So this is a live chart here. Let's look at this. Let's look at the CL. And let's just try to read, you know, what's going on here. I want to show you also how I am, I'm disconnected. I want to show how I am drawing the trend line. Okay, so I'm just going to take, I've got a lot of charts open, that's why I've got all these to the right. I'm looking for minus 150, right? Is that, do we meet the requirement? Yeah, okay, draw it up. And this is my line. Notice I want to touch part of the CCI. And then I just extend it out. Now that says sell. Look at this right here. Sell. That's the way that works. Here I can go again. Oops. I tell you, I got people I've shown this to. You won't believe the fan letters. Oh my gosh, it made such a difference in my trading. You got a short signal here. Well, there's your signal right here. Okay, remember that? Look at that little arrow there. Okay. And down we go. Now, what about this? You know, people say, well, gosh, I missed the signal. You know, I missed the signal. Gosh, when can I get in? I hear that all the time. Well, you draw your line. What's the rule? 150 or lower, right? Draw that line. That means I can get in there. Where is that? Let's look at this. Probably right here. No. I think it's really the next one. I think it's actually this one. Okay. Oh, come on, buddy. Now that SIG goes short. Then somebody says, wait a minute, I missed that. Where can I get in? I'm scared to get in. We've all been there. Don't worry about it. What's the rule? Am I below 150? Yeah. Draw that line. Can I touch? Yeah. Where did I touch? What does that mean? I touched right here. Got it? So that's a short. Well, where's that? Let's look at it. Oh, yeah. I think that's probably about right there. Well, you know, it's probably the next bar actually. Okay, so I'm probably one bar ahead. It's probably at the end of this bar. Now, how do we know? How do we know price is going to keep falling? Obviously, we don't. But our method is so robust that we simply take the trade. We simply take the trade. Here's another one. Here's another one. Now look, I can't really touch the side. A bump, I have to run it all up there. But that's a legitimate signal. All right, buddy, move over. Okay. Here's another one. I think you get the message. I think you get the message, okay? This is all that's involved. Now, you're probably saying, well, why aren't you flashing up more signals here? You're showing me, but your program didn't do it. Okay. The program is assuming you've already entered. That's what he's doing. He's saying, hey, you're already in the trade. This is where you add on. Trade's going so well, you're getting more signals, you add on contracts. Why not? Okay. All right, let me just try something real quick. Okay. Okay. Now, what this shows you is that there were 2 more signals generated. This is now we're live. Hello. I'm going to get ahead of the presentation a little bit. The question is always, well, where's my protective stop? I'm going to show you the best protective stop you can possibly use, in my opinion. If you get a signal, you put your protective stop. If you're going to go short, whoever is higher, either the trigger bar or the previous bar. And if you do that, you're going to stay in that trade. This is a 10 range bar, crude. That means each bar has a range of 10 ticks. So 2 of these bars, that's a $200, roughly $200 protective stop, which is, some people think, well, that's absurd. Some people think, no, I want a 6-tick stop. Good luck with that in crude. You're going to get chewed up. So we would just be, let me see if I can open this up just a little bit. If we took the signal, then we would have put our stop right here. And this is one of those instances where, unfortunately, we were taken out right here. Well, boy, it would have been nice. It would have been nice if that would have worked. It didn't work. But let's look at this one. So that was a stop out. But look at this. There's a signal. Here's a stop, initial stop, just above there. And you're in. Okay, you're in. Unbelievable move. So my point is, there's going to be noise when we use the prior price bar. This helps us out tremendously. You start testing that and you're going to be shocked. And if you really, really, really test it hard and believe in it, I think you're going to see an improvement in your trading results. Now, what is this? This is a built-in protective stop. It's called the Rime Stop. And so what we're doing here is we're saying use this stop. Sometimes it's going to be a little bit more as an initial stop. I want you to understand that term initial. He's basically saying, I want to move you out of the firing line. I want you to survive a whipsaw. So his stop, this big stop, how much is that? Okay, let's say we got in, we got the signal and just jumped right in, okay? And then it went against us. So this guy's saying the stop should be, oh, let's see here, how much is that? That's a little bit rich. $335. That's a little bit rich. But I generally do about 200, 220, something like that. Now let me just look at the next one. And this is going according to how the market's moving. So let's say we got in, we saw the bar complete and then slammed on it. Boom. All right. Well, now he's saying the stop should be, so that this is more my style. This is $214 stop. Okay. And the deal is, you stay with this trade until you get a price close above. And then you get out. So when there's a price close above the red line, you're out. It's just another idea, but it's pretty effective. What's so important? Follow through. Let me just go back over here. What else can you do? Well, what about just using a simple method of going in at the previous bar high? So that means this one right here. Let me measure this for you. Let's say we entered right there. Okay, right a minute at the bar print. Okay, so again, there's about a $211 stop. Yeah. If I'm trying 6 ticks, guess what? They cut my head off and then they show me the head. And I'm looking at my headless torso because it's happened so fast. You've got to understand your instrument, how it moves. All right, and you've got to test. You've got to test. Just beautiful. And notice that working, you can do that. Let me get rid of that. You can take this type of a protective stop and then say, okay, after I'm initially entered, then I'll trail it according to this, the Rime Stop. Why not? Look how it keeps me in the trade. How much is that worth? So here's where it got out. Right there. The green bar prints over the red line. Do you see that? Where is it? Right here. This is where you're taken out. Good. All right, I hope that this helps. Let me get back to the presentation. I love talking to traders. All right. Now, there are 4 other patterns that I teach beyond the diagonal trendline break. And when I say pattern, I mean a pattern on the CCI. 50% of these trades are accomplished with diagonal trendline break. So what I'm giving you today is something you can immediately test and be very, very happy. Key points to remember: draw the trend line starting at plus or minus 150. Now my own work, empirical work, has shown that if you discipline yourself to wait until you can draw that line at plus or minus 150, you're probably going to get greater follow through once the line is broken. Now obviously, if the line comes up to maybe 146, 147, I'm not going to split hairs. But as a general rule, if it's 150 or higher, when that line is broken, you're going to have good momentum, or should say good follow through, as a general rule. So we know that better trades are in markets showing momentum, and we're going to use the 14-period CCI for intraday application on chart time frames below 60 minutes, okay? Or like on my range bars, or the Rinko, or whatever you want to use, Hankanashi, okay? Any of those things. So I think you should first focus on trend trades, because there's a reason they say the trend is your friend. And only after you've mastered trend trading should you consider counter trend. Okay, just a fact of life. If you're one of these people that you have to trade constantly and that you are flipping from trend to counter trend, and if you really do not know what you're doing, you're going to be chewed up and spit out and left on the side of the road. You can use the confirmation price bar close unless the trend is super strong. What does that mean? Well, that means if you want to, let another price bar go by. If that helps you feel more confident about the trade. We talked about intraday long and short. Where are you going to put that protective stop? If you're going to go long, you place your stop below the trigger bar or the prior price bar to the trigger, whoever's lower. If you're going to go short, you place your stop, and it's critical that you understand this is initial stop. Initial stop. You place that stop above the trigger bar or the prior price bar to the trigger bar. Okay, whoever's higher, and then you go short. Now, use of trailing stop using logic of larger initial stop followed by tightening of the protective stop as a trade moves in the intended direction. What does that mean? What that means is a lot of times we're using a larger initial stop. Sure, you know, $200, $250, $220, whatever, $200. But if we use this Rime Stop, as the market looks like it's turning against us, automatically, the stop is tightening. And then you're going to find that maybe all you've got at risk is $60 or $30. Or maybe it's starting to bank profits. Okay? So you can see that if a trade's up $300, if you get stopped out, maybe you're going to make $100. Right? And then if it goes against you more, suddenly the stop moves closer. And now you're going to make, I'm just throwing a number out there, maybe now you make $200 if you're stopped out. In other words, it senses the movement of the price bars and says that something is not right. We need to be conservative. So this is a very busy chart. This is an older chart of the YM. Very busy. I know that. But it shows you the beauty of using this kind of trail. Okay? Absolutely. Let me see if I can... diagonal trendline break, go long. Diagonal trendline break, go long. Diagonal trendline break. Go long, but it went into a choppy period, right? Well, what is that? Lunchtime, okay. Diagonal trendline break, go long. Up we go. Here it is, 11:58. You know, you're going to get this. This is why I prefer trading in the morning and coming back in the afternoon. Now, a lot of times we get these lunchtime trades and you come back and say, gosh, I should have sat there. Hey, that's your decision. At this point in my life, I am not sitting in front of the computer the entire session. I don't want to. I don't need to. But if you want to, there is absolutely no problem. And you might be saying, well, wait, you're using a 10 range bar on the CL and now you've got 15 range bar on the YM. Yeah. I used 10 on the CL. I used 10 on gold. I used 10 on ES. I used 15 on YM. I used 20 on NQ. Why 20? Because it can absolutely cut you up. It moves very fast. Now, I think entries are a dime a dozen. I think the most difficult aspect of trading is exits. So there are several considerations. The easiest is just profit targets. Just profit targets. You decide the target. And, you know, you hit the target, you're out. Boom. Thank you very much. If you want to use the CCI, if the CCI starts, if it's up over 150 and starts turning around, you're being told, hey, I'm losing some momentum here. That's your first warning. If the CCI crosses the 100 line going back towards zero, or the minus 100 line going back towards zero, you need to be out of the trade. You need to be out of the trade. And with CCI, you need to let the bar print. Okay, you need to let the bar print. Or you can trail the stop for capturing greater gains. And I showed you the trailing method. Everything that we've talked about today is robust across any instrument, across any time frame. And if an action repeats, we know it is an edge. We can trade it. I prefer using activity-based bars rather than just looking at my watch and saying, okay, well, 5 minutes went by, so I'm going to look at a price bar. The only time I like the price bar time charts is in extremely slow markets. I think you should have some no-go rules, especially for day trading. Absolutely. So I'm not interested in taking a trade if the range is around 200 to 250. And I've incorporated this in the Rime's range bar sniper. Okay? In day trading, if you're locked in a range of $200, $225, if you're in that kind of a range, by the time you get in, it is going to go against you. And I've seen these kind of ranges last for hours. Just understand, you need no-go rules. You must let price resolve the issue. Because if you're simply blindly following the oscillators, or you're following a moving average, and that's all you're following, it can chop you up. Or maybe you're following volume, and you don't realize how the flash boys and the spoofing has ruined volume. You just don't understand that. A lot of people don't. Volume is still, they read it in the textbooks, and volume, I got to be following volume. Well, in day trading, I like to think that we are following the people who make the volume. Bottom line, if you're sideways, let price resolve the chop. Okay? I think also a very important understanding, you could tell your broker, hey, if I lose $1,000 or if I lose $1,200, just take me out. Because my mind is so into the trading, I'm not seeing what I should be seeing. So just take me out. That's called a broker imposed limit, where you tell the broker, hey, if I lose a certain amount, just take me out. You need to understand, in a fast market, your statement can say you lost $2,000. And you call the broker and say, look here, I told you to take me out, stop me from trading if I lost $1,200. I lost $2,000. That's not my fault. And the truth is, the market was so fast that by the time they tried to take you out, the market moved. And when you sign to trade electronically, you give up every single right. And that's what you really need to appreciate. If there's a data problem, it's on you. If there's a problem with the software, it's on you. And you have agreed to this. You just didn't read the fine print. All right. The day trading mind, we buy into the day trading dream of financial freedom through day trading, you know? Well, the reality is this is an extremely tough business. Chance favors the prepared mind. So either you control your mind or you stop immediately. That's it. If you have any questions, I'll take questions. I want to thank you for your time. You've got a strategy you can immediately test. I want to thank AgenaTrader. I want to remind you, if you want to sign up for Rooster Call, go to my website, hitthemarktrading.com, go to the contacts page and sign up for Rooster Call. Okay? If you want to learn more about AgenaTrader, again, go to my webpage, Clients and Resources. Click on AgenaTrader. All right? My website will show you my courses available, intensive immersion, or the boot camp for position trading. I sent this out this morning. It's just typical. When you have a good moving market and you know the signals you're looking for, do you see volume on my chart anywhere? Of course not. Of course not. What did I say in my Rooster Call this morning? I said, you know, we're rolling the contracts on July 18. It is very common, normal, that the market fall into the roll. This is why you need to read the Rooster Call. I throw out all kind of interesting tidbits. And if you, after 30 days, you want to pay for it, great. You'll get it every single day. If you're interested in this Rime's Range Bar Sniper package, they got a 14-day trial, or you get a refund. You can either purchase the whole thing or you can rent it. It's up to you. Cheaper to buy. I think you should run your test, extensively run your test, and you're going to gain, I hope, a quiet confidence. And then you're just simply going to wash, rinse, and repeat. Wash, rinse, repeat. Just like the professionals. Okay? All right, let me see if I got any questions. Let's see here. I want to move this down. Let's see here. Do you trade every day, or do you have specific days that I trade? Oh, and there's Larry. Hey, Larry. Thanks for being here, Larry. I have certain days. I like to trade Tuesday, Wednesday, Thursday, especially in the summertime. Tuesday, Wednesday, and Thursday. Now, these markets with this trade war stuff going on, and the way that crude's moving, I have no problem if anyone wants to trade on a Friday. And in fact, I traded last Friday. But empirical evidence by myself and others have proven your better days for trading are Tuesday, Wednesday, and Thursday. Now, obviously, today was a fantastic day for trading crude, obviously. But many times in the summer, gosh, it's so dead on Friday or on Monday. So I prefer Tuesday, Wednesday, and Thursday. I prefer the first hour and a half. That's the market open. I am never in a rush to trade at 9:30. In fact, I call 9:30 to 9:45 a killing field because they are trying to get the retail trader. It looks like, you know, say the market's been up overnight, and the retail trader says, gosh, they're going to take it higher. And then what happens? The market opens and they slam it down to fill any kind of a gap. They fill a gap. So that the first 15 minutes, I've seen the Russell 2000 move up and down $300 all within 1 minute. Just in the blink of an eye, it moves up $300. Blink an eye, it moves down $300. That's the first 15 minutes. So even if I miss trades, I don't care. The market seems to settle down around 9:45. It really does. And then you can go on. There is a time in the afternoon that we call the afternoon rush hour, and sometimes I'll trade that as well. But I prefer the morning, and then I like to get out and enjoy my day. I really do. A lot to do. You know, you buy into this idea of trading freedom, and then you end up being chained to the desk, right? And then it's like, wait a minute. I became a trader so that I didn't have to do this every single hour and minute. So you simply find the times when the market seems to be moving the most. You're not right 100%. Sometimes the market will take off right at 9:30 and never look back. Those days are rare, extremely rare. Sometimes you'll see the market move tremendously during the lunch hour. Hey, it happens. But the bottom line is, you run your own statistics through your own trading, whatever times you select, and then you say, okay, gosh, it looks like more often than not I have losers over the lunch hour. Maybe I don't want to trade that. Or maybe you find out if we have a Fed minutes release, or maybe we have a FOMC meeting where they're going to discuss interest rates, maybe I should take a very, very long lunch break, because nothing will happen after the morning rush hour on FOMC. Nothing happens until 2 o'clock. So you learn these things. All right, are there any other questions? Anything I can help you with? If not, I'm going to bid you a fond adieu. I'm going to be posting this recording, and we will you'll be able to view it again. If you have any questions, you can contact me, Martin at hitthemarktrading.com. Okay, I just posted that in the chat, and I look forward to talking with you. Bye-bye now.